Even though it's September, you may be asking yourself the question, why are we releasing a video talking about end of year tax moves? That's what we want to look at now because, believe it or not, it could be worth your time to start that process now instead of waiting to watch this video at the end of the year and running out of time. So enjoy this video as we talk about some things that you can do this year to try to help your tax burden on your savings and income moving forward. Hello, I'm John Vandergriff. I'm one of the owners and the wealth planning team lead at Blue Ridge Wealth Planners. And our busy season, as you look through the year, is different than that of CPAs. Really, the last quarter of the year, we spend a lot of our time focusing on the things that we're going to talk about in our video today. So I want to walk you through end of year tax moves. Some of these things don't have to wait until the end of the year, but if you've not done them, a lot of the things we're going to talk about today need to be taken care of by December 31st of this tax year for it to count toward 2024 taxes. So as we look at this, the first and I would say most urgent of these is to have a focus on RMDs or required minimum distribution. So if you are 73 or older today, you need to be taking money out of your retirement accounts, retirement plans, 401ks, IRAs, anything that was a tax deferred investment, as long as you're not actively employed with that 401k company and you don't own more than 5% of that company. That's really the only exception for not needing to take required minimum distributions. You'll see here the calculation that you go through, and what you notice, these are rough percentages, but basically you take the December 31st value of those retirement accounts, divide that number by, if you were 73, 26 and a half, that would be roughly 3.77%. But if you divide it by this divisor, it'll give you the exact total that is the minimum that you have to take out. Now, obviously you can take more than that if you would like to, but as we look at this, it's important for you to be in a position where you understand that this is mandatory. As we look at it, the penalty for not taking your RMD is 25% of what you should have taken out, and then they're going to make you take that RMD out anyway. So again, pretty hefty penalty on top of the taxes that are owed on this money, increasing into maybe multiple brackets as we look at things moving forward. So again, as we look at this, we want to make sure that we're plugging in all of the accounts that we have, adding those things together. Now, one thing that's important, and this starts to really back up why the shift from a 401k to an IRA in retirement could make sense, because RMDs will affect 401ks differently than they do IRAs. So let's say you're in a position where you have 3 separate 401ks. The way that 401ks are structured from an RMD standpoint, they will each make you take that required percentage out of each of the buckets, irregardless of what you do out of the other buckets. A lot of retirement plans will look at these assets as if it's the only retirement account that you have, and they're obligated to send that out, versus if you were in a position where you had 3 different IRAs, as long as you take out the total of the money that you need to take out, you could take it all from this account and leave the other 2 alone. And so let's say, this side over here is aggressive and it ranges from aggressive to conservative. If the market was down, you may want to take your RMD out of that bucket. If the market's up, you could really take it out of all of them, but maybe you take it out of the growth bucket that is maybe coming exclusively out of profits that you made during that year. So as we look at this, if you are new to RMDs and you're turning 73 in the tax year of 2024, technically you have until April the 15th next year to be able to take out that RMD, so you don't have to wait until the end of the year. But many times we advise you to do that within this tax year, because if you follow this strategy, you'll actually have to have 2 RMDs if you waited until, let's say, March of next year, and then by December 31st, you'll have to take your year 74 RMD out. Otherwise, you would have that penalty. So RMDs are a very important thing to make sure that you are including. We're going to talk about how RMDs will affect some of the other areas of end-of-year tax moves as we progress through this video. But as we look at this, it's maybe the first place to start if you are 73 or older. And RMDs will actually change. So we've had a lot of changes in RMDs. Some people thought it was at 70, then it was at 72. Currently it's 73. And then if you don't turn 73 until 2020 or 2033 or after, the RMD age is actually going to back up to 75. Now they could change the table between now and then, but as the rules are now, that's what we're set to experience when it comes to RMDs and how you age into those. So very important thing that we need to make sure that we factor into conversations that we have with people this year if RMDs are applicable. Now, the other thing that we talk about a lot when it comes to planning and specifically around tax conversations is the use of Roth conversions. So as we've talked about in previous videos, this is the move of taking IRA or retirement accounts like 401ks and transitioning those over to a Roth IRA. And the key here is understanding what gets affected whenever you have this conversation, because, you know, let's say you're in a position where you're still working, you've got money outside of your 401k that you're looking to do a Roth conversion with, and let's say your taxable income is at $100,000 right now, okay? So if we look at that, that's your salary. What this is a chart that shows 2024 tax brackets, but also adds on top of it standard deductions, which is typically the way we think about our income. So if we were looking at a conversion conversation and we said, well, we're at $100,000 of taxable money before we do this, and let's say we wanted to maximize the current tax bracket that we're in at 12%, then this shows that you would have roughly $23,500 that you could convert and keep that within the 12% tax bracket. If you went above that, then you would cross into the next bracket here just on the dollars that went above. So if you decided to do, in this case, $30,000, the first $23,500 would be taxable at 12, the next $6,500 would be taxable at 22%. So again, as we look at this, this is kind of the conversation that we have even with existing clients today, because you don't plan for Roth conversions in advance. You really need to do them in each calendar year as you progress through life. Your income obviously changes if you make the transition from work to retirement. Maybe your income goes down and then it gives you more opportunity at lower brackets. The big thing that we're paying attention to is just as the tax code exists, these brackets as we know them, which went in place in 2018, are set to expire or sunset January 1 of 2026. And so again, that's where we're going to see, you know, the 0 and 10 will stay the same, but this will become 15, then 25, then 28, and then 33, and then the 35 will stay the same, and then the top bracket will go up 39.6. Truthfully, I don't think this will be all the tax increase that we see just because of the rampant spending that's happening in our government, as well as issues with Social Security and Medicare. But again, you see some increases that happen kind of in the middle of this bracket that become fairly substantial. I mean, a 25% tax increase, usually somewhere between a 12 to 25% increase is what we're looking at really in the middle of these categories. So again, if we're concerned about tax increase in the future, it's one of those conversations we want to have of how do we maximize this year? How do we maximize the savings that we have, really starting the ball rolling into Roth conversions? Maybe we fill up this bracket, maybe we go up to the top of the 22 or the 24%. Again, we want to be in a position where we're having those conversations, because again, most people are not having those conversations. They're coming to YouTube and watching videos like ours to try to gather as much information as you can. The key to these conversations is making sure that you're doing it not in a vacuum, but really associating it as a part of an overall financial plan for your retirement. So as we look at this, I do want to add a screen here to talk about how the first two things that we've talked about combine. So we have RMDs, we have Roth conversions. One of the questions that we get often is, you know, can we do Roth conversions? Let's see here. After we reach RMD ages? And the answer is yes, but you have to understand the ordering that needs to take place. So the way that it's structured, after you reach RMD age, you first have to satisfy your RMD before you are able to do any Roth conversions. So let me erase that. There we go. So again, if you've got an RMD of $10,000 that you have to take out, you've got to take that $10,000 out of your retirement accounts first. Realize that. Then you could go on top of that and do conversions at whatever level that you want to pay taxes on. That could make sense for two reasons. As we looked at before, maybe this is the lowest tax environment that you're ever going to be in, and so trying to maximize that as much as you can is part of the conversation. The other is, the more you pay taxes out this year, the less overall RMD that you will have the following year. Because again, RMDs are resetting every year based on your December 31st value of the total amount of money that you have in pre-tax dollars. So as we look at this, once you satisfy the RMD, then you are free to convert as much, honestly, as you're willing to pay taxes on. When it comes to this conversation, that people will often ask me, what is the limit? The limit is whatever you are willing to write a check to the government for. But as you said, let's say you're in a position where you're trying to drain this over time. It may not make sense to do this all at once, but let's say over a period of 3 years, you're able to kind of have enough room in each of the tax brackets to be able to do these conversions and factor in RMDs, and then eliminate the need for forced distributions that increase your tax threshold potentially higher than you want it to be, okay? So again, you can do Roth conversions after RMD age. It's just important to be strategic with that and again, include that in an overall plan. Now, charitable giving, for you to be able to get any credit at all for how you donate money to 501c3 charities, churches, nonprofit organizations, those gifts need to be given by December 31st. But the limiting factor for a lot of people is, the standard deduction as it exists right now, and this is for anybody that's under the age of 65, $29,200 is what you have as a standard deduction. So if you're giving to charitable causes and you're not clearing this with a combination of deductible expenses, charitable contributions, property taxes, or different taxes that are eligible for deduction, then you're really not getting any credit for this. And the thing that I always like to talk through with people is the first thing that you need to consider when it comes to charitable giving is, do you want to give money to charity? And if you're already doing it, that's a great thing. We want to try to help you figure out ways to get credit for that and be strategic with it in the way that it fits your overall plan. Because the problem is, let's say you're giving $10,000 a year and you don't have any other ways to deduct money from where your life is right now. You're not going to get any credit for that because your $100,000 before deductions is going to be in a position where you're just going to have the flat $29,200 come off of it, and then you're at a $70,800 income. So I want to walk you through, if we're in this same type of position, how can we do a similar thing through strategic uses in charitable giving options to try to help you get more credit for the things that you may already be doing from a tax perspective. So first one of those that we want to look at is what's called donor advised funds. So this is a way that you can either give first appreciated assets. So let's say you have stocks that have accumulated a capital gain. So you've got a stock that, let's say you bought for $5,000 and then it's doubled in value, and you want to be able to give that $10,000 to charity without paying taxes first, then giving it. You could actually do that through a donor advised fund and avoid paying the tax on that taxable gain. The limitation on your appreciated assets is actually 30% of your taxable income. So again, you could go up to 30% of your taxable income. And what if you say, well, John, my taxable income is not very high? Well, one of the things that we do often is you can actually make your taxable income higher through the use of Roth conversions. And then that would be a way to lessen the impact of the conversion, but also if you've got a significant amount of gains, as long as you're charitably inclined, you've got a way that you could kind of whittle that down and also maybe make it to where your Roth conversions are more efficient overall. If you don't have appreciated assets that you want to give, cash donations, I think your limitation there is 60% of taxable income. So you could do some combination of this, but I think your maximum overall would be 60. So if you did 30 here, it would be 30% on the cash side as well. So as we look at this, you say, well, John, why in the world would I do this? Because even if I give to the donor advised fund $10,000, I'm still not getting tax credit for this because I'm not over the standard deduction. That is true. However, if you say, well, my goal is to give $10,000 every year for the next 5 years, you have the ability to do that from a contribution perspective. You could technically give, let's say we're in the same position where your taxable income is $100,000 pre-deduction. You could give 5 years worth. You could give less than that, but let's look at this scenario where you give 5 years worth of $10,000 donations. So $50,000. You still can distribute those at $10,000 a year from the donor advised fund. But if we do this, that takes your taxable income from, as we looked at here, $70,800 down to $50,000, right? And then the following years, you claim the standard deduction, but you give from the donor advised fund, and it allows you to get a bigger benefit out of that money. That is standard deduction, but also you get credit for money that you actually gave to the charity in that one particular tax year. So very good strategy if you have after-tax money that has gains on it for sure. If you have cash sitting around and you're wanting to maximize how much credit you can get for what you're already doing charitably, this is a thing to keep in mind. The last one here is actually kind of tying the loop on our section here with RMDs, and this is what are called QCDs. So qualified charitable distributions. These are opportunities where once you are over the age of 70 and a half, so they kept this the same even though they raised RMDs from this point, you can give up to $100,000 directly from an IRA to the 501c3 charity and it not be a taxable gain. So again, how does this help us? Well, let's say we were in a position where, so you technically had $90,000, you were forced to take $10,000 out of your IRA, so you did that, and then through the use of an RMD, so you've got $100,000 here of income, and then standard deduction, $29,200. So again, if you don't have the ability to get credit for this with other things, you're going to be in that same situation that we talked about before with a taxable income of $70,800. Now, if instead of doing it as a withdrawal to you that you wrote a check for, if you change this RMD to a qualified charitable distribution, which is effectively doing exactly what you were before, it just never touches you, this will make it to where that $10,000 will not show up as a taxable event. And then what happens is you pay tax on $90,000, not $100,000. And if you take that standard deduction off, as we look at it, it basically lowers your taxable income by $10,000. Right? So again, being strategic in how you infuse charitable giving decisions into the way that you're viewing your income, but also overall tax conversations with your money, very important, because some of you may benefit a whole lot more from donor advised funds than you do through QCDs, or vice versa. Or you may want to use both at different times of your life. The key here is knowing that these options are available and utilizing them before the end of the year so that it can help maybe maximize some of the opportunity that you have this calendar year when it comes to tax decisions that you need to make. And as we tell in just about every video we do, this needs to be filtered through a conversation about everything that you're trying to do. If nobody's walked you through a holistic conversation outlining your goals and objectives, the income that you need, how you're funding that from investments or taxable sources, and again, into this family legacy conversation, too many times people have charitable aspirations that they want to leave behind when they're done with their money. I encourage people to try to infuse those into the conversation now so that it can specifically help the efficiency of this tax bucket more than anything else. So as we look at this, if you've not had this type of conversation, what you will do is you'll see a link below this video. I would encourage you to click that link, schedule a time where we can walk you through this. We still have plenty of time this year as long as you're watching this before December of 2024. Otherwise, you may be making plans that will actually go in place next year. But the key is just giving yourself enough time to have a holistic conversation, looking at everything, but then zeroing in on the things that do need to happen by the end of this year to make sure that you're actually making good decisions. So with that said, if you have any questions, feel free to leave those as comments below the video. We'll be happy to get back to you on that, or you may want to save those for a meeting. Regardless, we are happy that you joined us. Hopefully you learned some things that can help maximize the decisions you need to make by the end of the year. And if you need any assistance at all, let us know how we can help.